Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 28, 2026. Hey, how you doing? I hope you're having a good start to your weekend. Boy, last week was a tough week. Was tough for me. Probably my worst week in a year. It's been difficult for the bulls with everything that's going on in the Middle East, and it's been dangerous trading. You know, more times than not, the market goes up, but sometimes we get these situations like this, and it's quite volatile. So I hope you're staying safe out there. I hope you're following your process, following your stops, because this is a very brutal environment. You know, I have a lot of people that have asked me, are you going to take trades down here? Are you not going to take trades down here? And I always say the same thing. If it's a legitimate signal and I have the confluence combination of entry signals, I take the trade. I don't care what's going on. Doesn't mean I'm going to be right, but if I position size correctly, so I know what my maximum allowed loss is, and I have seen the rejections of levels prior to getting in, I take the trade. Because there will be some point where we have a rally, and if I didn't take the trade, then it's difficult to chase later. Because, you know, when you have these bear markets like this, these big sell-offs like this, when there is some kind of resolution of something, you'll have a skyrocketing move up, and a lot of people will miss that and they'll never get back in. So as far as how I am looking at this and what I'm doing, I'm just following my rules. I don't care what the news says. I don't care what the sentiment is. If I have a signal, I'll take it. If it doesn't work, I'll get out and I'll take another one. But that's how I am approaching this situation. So yeah, been a tough one, everybody. And, you know, I think today's podcast is going to be a lot about taking losses, not about profits, but it's a very important part of trading as well. So with that said, the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, all the positions that I have. We're going to talk about when I entered the trade, why I entered the trades, what the signal was, or what the confluences were. I'm going to talk about how I position size when I enter the trade, how I place my emergency stop, how I place my end of bar stop, how I go into trailing stop mode, how I take partial profits if the market moves in the direction that I want it to, and then ultimately how I exited the trade. So I hope this is going to be helpful for you, everybody. If it is, and you find something of value today in the podcast, I would really appreciate if you could hit the thumbs up button. It really helps out the channel. After we take a look at my positions and trades, we're going to talk a little bit about trader psychology. I don't think there's a more relevant week for trading psychology than right now, right where we're at. So I always find it helpful to talk about trader psychology, and I hope you'll find something helpful from it as well. After that, last night, I went down through my master watch list. I have identified 11 different potential trades for next week that I'm looking at. They're all very close to having a legitimate entry. They either just need to go up a little bit or they need to go down a little bit. And like I said, every Friday night, I go down through my master watch list. I look for confluences of signals that we are getting close to within striking distance of taking. So, and once I do this, so I have the 11 for next week, what I do is I just put them up on my screen, and then next week I will monitor them. And if one of them signals, you know, I'll have to take a look at it. And if it's good, I'll take the trade. So I did take a trade yesterday. I'll show you that when we go through the signals. So that's the format for today, everybody. And first of all, let's get this U.S. legal disclaimer out of the way, and then we'll get started. So hang tight, please.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with the open positions that I still have at the moment. First on deck is Palantir. I did enter Palantir all the way back here on the 5th of February at 129.62. You can see it's been a pretty good trade, still profitable. But I entered here based upon this green box. This green box is called an order block, and an order block is a support level from the past. So let's go back in the past and find this order block and what created this order block. This is the order block here on July 1st of 2025. So it goes all the way back to last year. So what makes this an order block? In order for an order block to be created, we need to first look for a swing low. A swing low is a low that has a higher low to the left and a higher low to the right. You can see this is the swing low. After a swing low, we want to look for a swing high. A swing high is just the opposite. It has a lower high to the left and a lower high to the right. So far, we have a swing low here and we have a swing low here. All right, so we've checked two boxes. The third thing we need to look for is another swing low. Here's the swing low, higher low to the left, higher low to the right. But the key is this swing low has to be lower than the first swing low. So we have these three in place now. We have a swing low here, we have a swing high here, and we have another swing low that's lower than the first swing low. So when all three of those are in place, we go back to the first swing high. Here's the swing high. Now, if in the future, if the market can go above that first swing high, is the second it goes above that swing high, that is what creates the order block. And the order here, as soon as this goes above this swing high, now I look to the left, I look for the lowest closing bar prior to the market structure change. I take the high and the low of this and I move this into the future and I wait for the price to come back down to that area. Now, this, as soon as we took out the swing high, it defined this as the order block. Then the market just went on a super rally. And what I want you to kind of picture in your head and think about is when the prices were up here and we look back to this order block, was smart money buying in this order block? Yeah, clearly they were buying here. When in the future, it went this high, right? It's just, it's 2020 that you can, hindsight, you can look back and go, yeah, well, clearly smart money was buying here. So the idea is when I look at an order block and I say, okay, this is the smart money area into the future, I want to wait for the price to come back to that smart money area. Now, does it mean, I mean, yes, it was smart money here, but does it mean in the future it will be smart money again? Not necessarily, right? Things can change in the world like they are right now. But in my experience, and I've been trading over 30 years, when the price does come back to that smart money area, it is more likely to bounce than not. But it doesn't all the time, but more times than not. So we have the swing low, we have the swing high, we have the lower swing low, we have the market structure to the upside, we define the smart money area, and we bring it into the future. Now it stayed above that smart money area for a long time, but then here we did finally come back down into the smart money area, and I bought here at 129.62 on the 6th of February. Okay, Why did I buy here? Well, there's multiple ways to get into an order block. You can look for a rejection of the high of the order block. You can look for a rejection of the low of the order block. You can look for a rejection of some other level inside the order block, like a 30 RSI level or a major moving average. But on this particular trade, I took this trade because it rejected the bottom of the order block. And just to be clear, what a rejection means is that on this particular day, we did go slightly underneath the order block, but we closed back in the order block. So that is a rejection of the bottom of the order block. And I make all my trades very close to the close of the market based upon the closing price. In my opinion, the closing price is the most valid price of the day. You have large financial institutions that come in at the end of the day. They're dealing with the most money. They have very smart people, the best information, the best technology, and I take my clues from the close of the day. And so all of my entries, all of my exits, except for an emergency stop, are based upon the closing price of the day. So okay, so that is why I entered here, rejection at the bottom of the order block at 129.62. Now, okay, I have my signal, I have my entry, I have to decide how many shares to buy. And I use a very simple formula that's quite effective that I like to make my position sizing decisions based upon what the volatility of the market is. And to do that, I simply can use the average true range times 2, the 2 ATR. Average true range is how much is this market expected to move over on any day based upon the last 20 days. I take that and I times it by 2. So the first input I use is the whatever the 2 ATR is on the day that I entered the trade. The second one is how much do I have in my trading account. So combining the two gives me the perfect amount of shares. So the first thing I have to decide is how much is in my trading account. And then I take 1% of that. Some people use 2, some people use 3, some people use a 0.5%. But for me, a percent makes sense. So I take 1% of my total trading account and I divide it by the value of the 2 ATR. So if I have $100,000, 1% of that is $1,000. And I divide that by the value of the 2 ATR, which is 1364. It tells me to buy 73 shares. Okay, so I entered here at 129.62. I position size like I just showed you. As soon as I enter, I refer back to that 2 ATR value, 1364, and I minus that from my entry, and I place this red line here. This is my emergency stop. If I have 73 shares and it moves down 13.64%, I'm going to lose, because we just did the math, $1,000. That's my maximum allowed loss on this trade. And so if I lose 1%, it's not fun, it's not great, but you can recover from that. But the good news is that an emergency stop loss only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it is not going to be because it hit my emergency stop. It is going to be because it closed below my end of bar stop. And on this particular trade, my end of bar stop is simply a close back below the order block. And I entered very close to the order block. So if the next day it closed down, 2, 3 cents, 5 cents, even a penny, I simply would have got out for a small loss. And that's the key in trading, is structuring a trade, position sizing correctly, having your worst case scenario, which is the emergency stop, but having your end of bar stop be very close to your entry so that if you get out, okay, you get out, you have a small loss, you move on. Because keeping your losses small is the most important part in trading. Like I said, the emergency stop, that's the worst case scenario. But 95% of the time, if I have a loss, it will be because it closed below my end of bar stop. Okay, so here we go. Rejected the bottom of the order block. I position size based upon what I just showed you. I entered the trade. I placed my emergency stop 2 ATRs below. I know my end of bar stop is a close below the low of the order block. The next thing I do is I refer back to the value of the 1.5 ATR. Right here, the value of the 1.5 ATR is $10.23. So as soon as I enter, I take my entry price plus the value of the 1.5 ATR and I place it above my entry. This is my trailing stop level. And what this means is in the future, if I get to my trailing stop level, I don't do anything. It just means that I'm now at a threshold. I'm in trailing stop mode, which means in the future, if I have a close below a previous bar's low, I'm going to exit half of the position. And in trading, when you enter a trade and it starts moving your way, and for me, that level is 1.5 ATRs above my entry, then I want to tighten everything up. I want to move all my stops up because it's moved in my direction and I don't want to let it go all the way back. And by getting out with the close below a previous bar's low after reaching trailing stop level and selling half the position, that has the effect of reducing your risk by 50%, right? It moves everything up. I'm not moving the actual levels up, but by selling half, it has that effect of moving everything up by 50%. Okay? Okay, so everything I have talked about so far, as far as end of bar stop, emergency stop, getting out of half if you have a close below a previous bar's low after reaching trailing stop level, these are all defensive moves. So in other words, if the market moves against me, if it moves in a direction I don't want it to go, I have to take some action. That is the defensive action. But I also like to play offense in my trading, not just defense in my trading. And the way that I do that is I take a partial profit each day if the price moves a certain amount from the previous bar's close. So I'm in this trade right now, Palantir. It's very simple. I take the closing price. Right now, the closing price is 143.06. And now I refer to the 0.45 ATR value, which is $3.07. So I take the closing price, 143.06, and this 0.45 ATR value changes every day. But for Monday, it is 3.07. So the closing price, 143.06 plus 307. My first profit target for Monday is going to be 146.13. 146.13. Okay, there's my first profit target. I place 3 profit targets every day. So I just showed you how to do the first profit target. Now let me show you how to do the second. All I do is I take the first profit target that I just did the math, and I add it to it again. 3.07. My second profit target for Monday is 149.20. And then I do it one more time. I take the second profit target, 149.20, and add the 0.45 to it again, plus 3.07. My third profit target for Monday is 152.27. Now, I know where my profit targets are for Monday. They change every day because it's all based upon the previous bar's close. But the question is, well, how much profit do I take? It's very simple. However many shares I go into the day with, I take 10% at each level. So if I go into the trade with 70 shares, I'm going to take 7 here, 7 here, and 7 here. And I just program those into my trading platform as limit orders. Now, if the market goes up decently, maybe I hit one profit target. Great. And you hit one profit target a lot. And what's nice about that is that you are locking in some gains, not a lot, just a partial, but it's a good feeling to take a little off. And if the market in the future goes down against you, you're really glad that you took some of those partial profits off because it will mitigate the loss. So, and it just makes sense, right? In sports, you have to play offense and defense. In trading, it's a sport. it's important to me to play offense and defense. Now, if you have a really good day, maybe you hit 2 profit targets. That's fantastic. If you have a fantastic day, you hit 3 profit targets. And again, it just has the effect of reducing your position size, makes the trade more comfortable. And again, if it reverses and goes back down, you are really glad that you get some of those profit targets. Okay, so there we go. Now, we've kind of covered all the basics of the trade, and now let's actually go through this trade and see how I managed it. So again, starting here, enter the trade here on the 5th of February at 129.62 with a rejection of the bottom of the order block. Okay, placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. I placed my 1.5 ATR trailing stop level above. The next day goes up. Fantastic. Hit a profit target. Took a little off. Next day goes up again. Big bar up where I hit multiple profit targets. And also on this particular day, we got to my 1.5 ATR trailing stop level, which now puts me into trailing stop mode. I don't do anything, but now in the future, if I have a close below previous bar's low, I'm going to get out of half of my remaining shares. The next day is down a little, but it didn't close below the previous bar's low, so I do nothing. The next day, yes, we did close below the previous bar's low. After reaching trailing stop level, what do I do? I take off half of the remaining shares that I have, and I did that for a gain of 4.61%. Okay, the next day down again. I really thought on this day that I would be stopped out of the trade, but you can see it did go below the low of the order block, which was my stop, but it closed back in it, keeping me in the trade. The next day happened again, went below, closed above, kept me in the trade. Next day happened again. Next day we went up. I was able to sell. I took a partial profit into that strength during the day. Then we head back down. 2 more days of testing the bottom of the order block. On this particular day, on the 24th, I really, again, thought I would be stopped out of the trade, but it did close above, keeping me in the trade. The next day, up nicely, profit target into that day. The next day up, next day up, next day, nice move up where I took 2 partial profits into that day. Next day up again, partial profits there. Next day nothing, next day partial profits. Then we moved kind of sideways here for over a week. Here on the 23rd, again, I sold into that strength. And again, by me selling into that strength, I'm continually reducing my position size. And then, of course, the last few days, we have just gone down, 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 down. No profit targets, no nothing. But the remaining shares that I have on this particular trade are still up 9.45%. All right, let's go to the next trade. Apple. All right, so I entered Apple on the 20th of March at 247.80. Why did I enter this trade? Well, you see the green box. This is an order block from the past. And on the previous trade, I entered because we had a rejection at the bottom of the order block. This is a combination of a deep dip buy signal inside of an order block. It's a key level within a key level. The order blocks by themselves are key levels, but a major moving average like the 200, the 250, the 300-day moving average, these are key levels that large financial institutions tend to key off of. And in this particular situation, I'm not looking for a rejection of the high of the order block or the low of the order block. I'm looking for a rejection of a key moving average inside an order block. And that is exactly what happened on the 20th of March when I took this trade at 247.80. What we did on this particular day is that we rejected the 200-day moving average, meaning that during the day, we were slightly underneath it, but then we closed back above it. And that was my entry signal. So I entered at 247.80. I position sized by taking 1% of my capital divided by the value of the 2 ATR that showed me how many shares to buy. I placed my emergency stop 2 ATRs below my entry. And then my end of bar stop on this particular trade is simply a close below the 200-day moving average. So you can see my entry was very close to my end of bar stop, the 200. and giving me a good risk to reward. If it closed under the very next day, I just immediately get out. But if I'm risking a little to make a lot, that's the key for trading. So I entered here 247.80 with rejection of the 200-day moving average. Emergency stop, end of bar stops close below the 200. Of course, then I put my trailing stop level 1.5 ATRs above, and off we go. The next day, gapped open was a very good start to the trade. I hit 2 profit targets into that strength, which was fantastic, right off the bat. It bounced right at that 200, and the rest of the market saw that, and it did bounce. The next day, I did hit 1 profit target during the day near its high, so I took another profit target off. The next day didn't do much. Thursday, we did go up, and I did hit a profit target near the high of the day, which I'm grateful for, obviously. And we also got to trailing stop mode. Okay. After we get to trailing stop mode, if we have a close below previous bar's low, what do I have to do? I have to take off half. That happened Friday. It's our first close below a previous bar's low. After reaching trailing stop level, what did I do? I had to take off half of the position for a gain of 0.45%, which, listen, in this market, I was glad to have a gain. And so going forward with the remaining shares that I have, if we close under the 200-day moving average, I simply have to get out. That's my end of bar stop, right? But you can see in this particular trade, was I glad that I took partials here, took partials here, took partials here? Well, clearly, because that's higher than the current price. So come Monday, if it closes below the 200, I'm just going to have to get out. Of course, if we hit the emergency stop during the day, I'm going to have to get out of that as well. If we head up, well, I'll place my 3 profit targets for Monday. And if it moves up and hits some profit targets, great. So regardless of what happens with Apple, I know what I'm going to do. If it goes down, closes below the 200, I'm out. If it hits my emergency stop, I'm out. If it starts to go up, I'm going to sell into the strength. Now, if right now the RSI level is 37.97, if in the future, for whatever reason, we get back up 65 RSI level or higher, well, then the rule that I use is that if I get to a 65 RSI and then we close below the 5 EMA, which is this thin blue line, that's another way for me to get completely out of the trade. But we're not even close to that. If for some reason Apple's able to rally and go up next week and that happens, I will certainly show you. So I did take off half of the position for a gain of 0.45%, and the remaining shares that I have are currently up 0.45%. The Qs. I did enter the Qs on Friday. That was yesterday. I entered 562.57. Why? Well, we have an order block, the green box from the past. We have a 300-day moving average at this point, right? The 3 key moving averages that I look for are the 200-day moving average, which is the black line, the purple line, which is the 250-day moving average, and then the orange line, which is the 300-day moving average. On Friday, we did reject the 300-day moving average. You can see during the day, so we went slightly underneath the orange line, and then we closed back above it. So I entered 562.57. I position sized. I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. I placed my profit targets, my 3 profit targets for Monday. But Monday, if we close anywhere below this 300-day moving average, the 300-day moving average right now is 561.81. So it's down just a little less than $1 below. Monday, if it closes below, I'm simply out. That's it. I can always get back in if the next day it closes back above, but if it closes below, I'm out. And then if it continues down, fine, that's great. But right now, my line in the sand is this 300-day moving average. Monday, if it closes under the 300, I'm out. That's all there is to it. But I'm very close to it to begin with, so it is a good starting risk to reward. And basically I bought it 562.57. It's 562.58. So it's almost exactly break even. So we'll see what happens on the Qs. Silver. Okay, I did enter silver. Been in this trade for a while. All the way back here on the 18th of February at 69.80. Now you can see the green box here is the order block. We rejected the high of the order block because the previous day we closed in the order block, and then the day that I entered it closed above the order block. That is a rejection of the high of the order block. But in addition to that, you can see I've circled this blue bar here in a blue box. This is the reason I circled this. This is called a bullish abandoned baby. An abandoned baby happens when the previous day, a bullish abandoned baby happens when the previous day we gap down. So we gap down. So the market sentiment overnight was bearish. But the very next day we gapped up. And when you have a gap down followed by a gap up, that is what creates a bullish abandoned baby. And so I combined the two trades, bullish abandoned baby trade and the rejection of the order block trade, and I entered at 69.80. Now, when I take abandoned baby trades, I format them a little bit different. I don't have a trailing stop level. I don't have an end of bar stop level. I don't take partial profits. What I do, because these abandoned babies are such strong trades, is I place my emergency stop 2 ATRs below, just like I do on any other trade. And so if it does get down there, I lose 1% of my account. But to the upside, I place a 4 ATR profit target above. So my profit target level is 2 times what I'm risking. So again, that's good risk to reward. 2 ATR stop, 4 ATR profit target, and I just let the trade go. I'm either going to lose 1% of my account or I am going to make 2% of my account, right? That's guaranteed. Eventually, I'm either going to hit the stop or I'm going to hit the profit target. And so as I started off here, it started off really, really great. Now we've come back down and we're kind of sideways. So I am down on the trade. These are a little bit longer term trades. I am down on this trade 10%, but I'm not down 10% of my account, right? Because even if I got to my emergency stop, I'd only be down 1% of my account. So I'm down about 0.4% of the account on here. So it was nice to see silver kind of consolidate and move sideways for a week instead of going all the way down, but we'll see what happens. So either I'm going to hit the 2 ATR stop loss or the 4 ATR profit target. But currently this trade is down 10% from the entry. Okay, so those are the open positions right there. I had to exit a lot of positions this week because they hit my stop. So let's start off here with ARK. I did buy ARK back here on the 12th of February at 68.41. Rejection of the bottom of the order block, was below the order block, closed back in the order block. In addition to this was a very good signal. In addition to rejecting the bottom of the order block, it also rejected the 30 RSI intraday. During the day, it went below the 30 RSI, closed back above it. So that's a combination of a rejection of the bottom of the order block and a deep dip buy signal. Deep dip buy signals are either rejection of the 300, the 250, the 200, or a rejection of the 30 RSI. So that's why I took the trade. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop was just simply a close below the low of the order block. I placed my 1.5 ATR trailing stop level above, and here we go. Next day, bounced up, great. Hit a profit or sold a profit target into that strength. Next day down, nothing. Next day up again, did hit a profit target, and in addition to that, I did get to trailing stop level. Then we had a couple days of sideways motion. Here on the 23rd, we had our first close below a previous bar's low after reaching trailing stop level. I had to take off half of my position, which I did, thankfully, and locked in a gain of 2.29%. Next day, took off again, sold into the strength. Next day, took off again, sold into the strength. Then we had a few days of sideways motion, and then here on the 4th, I sold into that strength. And then we're up, we're down. When they're up, I take my profits. When they're down, I do nothing. And then we've just gradually gone down. Here, thankfully, on the 23rd, sold some into the strength when it gave it to me. And then Thursday, ultimately, we closed below the bottom of the order block. I had to get out of the trade for a loss on the remaining shares of 1.5%. But okay, let's think about how grateful that I am that I took partial profits when I had them, going into trailing stop mode, selling half here for half of everything for a gain of 2.29%. So this is, especially in this market where I've been in a trade for a while, and then ultimately I got stopped out last week with the big move down in the market. You can see how important it was and how advantageous it is to take little bits of profits when you have them. But nonetheless, the remaining shares on ARC, loss of 1.5%. Philip Morris. All right, I did enter Philip Morris here on the 24th of March at 163.87. Why? We have a 200-day moving average, the black line, living inside the green order block, key level within key level. On this particular day, we were below the 200. We closed above the 200. That's why I entered 163.87. Position size, placed my emergency stop 2 ATRs below my end of our stop, simply a close below the 200. I entered the trade very close to the 200, so therefore, if it even closes under by a little, I simply get out, and that's what I did. Never got to trailing stop level. I was in the trade for 2 days. It did go up the next day, did hit a profit target at least before it reversed, and it did close back below the 200, so I had to get out of the trade. Very small loss of 0.82%. So, generally when I have winning trades, I'm going to be in those for much longer than I'm going to be in a losing trade. And this is a good example of that. I was in, had the rejection of the 200 in the order block. It held, but then the very next day closed back below. I'm out. Listen, I can always get back in the future if I decide, right? But a loss of 0.82% on Philip Morris. Google. All right. I did enter Google here on the 13th of March at 302.20. Again, this trade happened inside an order block, okay? But when I talk about order blocks, rejection of the high of the order block, rejection of the low of the order block, rejection of a major moving average inside the order block. Well, in this case, we have the order block, but we don't have moving averages inside them. So sometimes I place my own levels, and the level that I placed is this green line here at $300.50. Why did I pick this level? I picked this level because this bar on the 9th of March, this big up bar, if you have a big up bar from a Fibonacci support level, 50% of that bar from the low to the high, if you retrace 50% back to that big up bar, generally there's going to be some inherent support there. So that's why I took the trade here on the 13th at 302.20, because during the day we tested that halfway mark and closed back above it. So I entered 302.20. I placed my emergency stop 2 ATRs below. As always, I placed my trailing stop level 1.5 ATRs above, and my end of bar stop is simply a close below $300.50. Next day, moved up. I hit a profit target, thankfully. Next day, moved up again, hit a profit target into that strength. Next day, nothing. Next day, nothing. Next day here on the 20th, we again tested that $350 level, closed back above it. That kept me in the trade. Next day, went up a little bit, holding, but then here on the 24th, we closed not only below the $350 level, we closed below the low, we closed below the order block. So clearly I had to get out of the trade. And so this trade started off nicely, but with this market just brutal with a loss of 4.08%. So the bad news is, yes, I had on this the remaining shares here a loss of 4.88%, but the good news is that I adhered to my stop and I didn't hold on to it and have to endure these 3 days down. Just, my best advice is be very patient with your winners, be very impatient with your losers. And it was a loser. It stopped below my stop. I got out. But in hindsight, of course, I'm really glad that I got out. Okay. UNH. All right. UNH. Little different strategy on UNH. I did enter UNH here the 25th of February at 282.86. Why? Let me bring your attention to this top green line and this bottom green line. This is the 1 ATR channel. This is the negative 1 ATR channel. Anywhere between these two lines is considered the value zone. This is an important place to potentially enter a trade. And the reason that I entered on a signal called a higher low V2. And the rules for a higher low V2 is, first of all, we need prices to close below the bottom green line, which we did. So check. Number one requirement, check. The second requirement is that we go back into the value zone, which we did. The third requirement is that we have a pullback and a reversal with the V1 or a V2. A V2 consists of three bars, bar 1, 2, 3. 2 goes under bar 1's low, 3 closes above bar 1's close. This is what a V2 is. V1 consists of 2 bars. And if you want to learn more about V1, V2 entry signals, go to my YouTube channel. I have a video there that explains in detail V1s and V2s. But again, close below the value zone, go into the value zone, pull back the value zone, create a V1 or a V2. And the reason it's called a higher low V1, V2 is this swing low here that created the V2 is higher up than the previous swing low. Now, I entered here 282.86. I placed my emergency stop, as always, 2 ATRs below. My end of bar stop on a V1 or a V2 is a close below halfway of the washout bar. The washout bar is always the number 2 bar on a V1 or a V2. So here's the halfway mark. Then I place my 1.5 ATR trailing stop level above. The next day, takes off. Great. Hit a profit target, sold into that strength. Then it reversed back down. Next day, again, thankfully, right, in hindsight, I took some of the trade off into that strength. This trade never really got going. We went down, hit a profit target here, but then here on the 23rd, we had a close underneath halfway the washout bar. I had to exit the trade. So tough week, lots of stops, and did get out here with a 4.85% loss. But again, it's important that I did take some of the position off into the strength when I had it. And it was no fun having to take this stop, but if we look to where we are now, certainly I'm glad that I did it. Okay, so those are the current open trades on the dailies, the current close trade on the daily. Now, I also trade the weekly bars. Now, weekly bar, every bar here is a week. And so for weekly entries and exits, I make my decision on Fridays, okay? So I've been in the dollar UUP for quite a long time, and which goes to show you if I'm in the trade for quite a long time, it means the trade's going my way. So I'll show you why I entered the trade. I entered the trade here on 7/11/2025 at 26.31. Why? Confluence of signals. First of all, the bar before we were in the order block. And then this particular bar, the entry bar, it closed above the high of the order block. That is rejection of the high of the order block. In addition to that, I have a major moving average. I have a 200-week moving average, the black line, inside the trade. Okay, so We closed under the 200, over the 200. That's a deep dip buy legit signal. And we closed in the order block, closed over the order block. That is also a legit signal. So I entered 2631. I placed my emergency stop 2 ATRs below. My end of bar stop is just simply a close under the 200-day moving average. I placed my 1.5 ATR trailing stop level above, and the next week took off. Good start to the trade, hit a profit target. Next week came back down, tested the 200, held above, kept me in the trade. Next week, up significantly where I hit multiple profit targets, also got to trailing stop level. Next week, down a little. Next week, we had our first close below a previous bar's low after reaching trailing stop level, locked in a gain of 0.49%. Then we moved sideways for about a month. Then we had this big down move here during the week, but it was strong enough and rallied and closed back above, kept me in the trade. And I'm very glad it did, because the next week it moved up, strong move up, sold and hit a profit target into that strength. Next week didn't do much. Next week up again strongly, did sell into the strength. Couple weeks of sideways motion. Next week up, sold into the strength. Here on the 21st, sold into the strength. Then we moved down for about a month. Then we had another move up here where I sold into strength on the 9th. Then we had a big move down. I thought for sure I was going to be out of the trade because we were well below the 200, but it was strong enough to close back in. Again, kept me in the trade. Next week up a little bit, profit target, came back, retested the 200. Next week up, sold a profit target into that strength. 1 week sideways, up again, very, very strong profit target. Next week up again, very, very strong. And at this point, I was talking a little earlier about whenever you get to the 65 RSI level, now the 5 EMA comes into play. Well, that happened here on the 13th. So at this point, it's very simple for me. If we close below this 5 EMA, the 5 EMA price right now is 27.62. If we close below that 5 EMA, I'm simply out of the trade. That will be the end of the trade. But this particular trade, the remaining shares that I have up 5.5%. Okay, now I did get stopped out on IBM on the weekly. I entered the trade on the 27th of February at 238.91. Why? It was a confluence of the rejection of the red line here, which is the 100-day moving average inside an order block. You can see during the week we went below. We closed back above the 100-day moving average. I entered 238.91. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 100-week moving average. I placed my 1.5 trailing stop level above. The next week we had a big rally, sold into that strength, which in hindsight, I'm very glad that I took some multiple profit targets into that strength. We had a couple weeks down. And then Friday, when the bar closed, we closed below my stop. I had to get out of the trade for a small loss, 1.29%. Listen, next week, if it closes back over, I could consider getting in again. But I did have to close out this for a loss of 1.29%. But again, back to partial profits. In hindsight, am I glad that I sold into the strength when I had some? Yes, for sure. So loss of 1.29%. So yeah, tough week, lots of stop outs for sure. But everybody, it is part of trading. The market just doesn't go up. And this has been brutal for sure. But when things are brutal, it also offers some opportunity. If things can calm down, we get some resolution in the Middle East. I don't know if we're going to, for sure. I have no idea. But if we do, I feel pretty confident in saying that the market will probably rally from that, but we don't know if it's going to happen. So all we can really do is pick our levels and wait for the market to reject those levels to tell us that the market's okay with rejecting those levels, and not try to predict, oh, we have to go up, or oh, we have to go down. Just let the market be your guide. The market, the charts are the truth. Everything you read on the news, this and that, personally, I can't trust it because there's always a narrative and there's always a bias, right? So the one thing that doesn't have a bias is the rejections or the rejections and the charts and the technicals. So, okay, before we head on to the potential trades for next week, let's first talk a little bit about trader psychology for a few minutes. Okay, so this comes from Mark Douglas. Mark Douglas is a very famous um, trading. He's not a psychologist, but he teaches trading psychology and how important it is. And Trading in the Zone, best-selling book. If you haven't read it, I would highly recommend you read this by Mark Douglas. It's really a classic. So let's see what Mark has to say. In order to produce consistent results that you can rely on, you're going to have to acquire an edge. I'm defining an edge as there is a higher probability of one thing happening over another. Very simple. When I buy a rejection of a 200-day moving average inside of an order block, it doesn't always work, but the probability is higher that it's going to go up than it's going to go down. Doesn't always work, but over time it happens more often. And so that's exactly what we're saying. I'm defining an edge as there is a higher probability of one thing happening over another. And that's what you need in your trading. So either you have the edge or the markets do. This is from Akil Stokes at Akil Stokes RTM. Either you have the edge or the markets do. If you have to question whether or not your strategy does or not, you need to stop trading immediately and find out. If not, you will go broke. So get yourself a process that has an edge. Whether you learn it from me or you learn it from someone else, it is important. Get yourself a setup, a strategy that more often goes in the direction that you want than it doesn't. And order blocks, major moving averages, higher low V1s, V2s, abandoned babies, all the ones that I use have an edge that more often goes my way than goes against me. But certainly, like this week, they don't always work, right? But over time, you have the edge, just like a casino has an edge. They don't win every hand or roll the dice or spin of the roulette wheel, but over time, there's a mathematical edge that's built in, and that's how they build all these things in Las Vegas. It's the same with trading. So, thanks, appreciate this. Good post from Mark Douglas, and thanks for Akil Stokes for posting that. All right, let's go to the potential trades for next week. Now, there's 11 of these, and I mention this every week, but look, there's 11 that are pretty close to potential legitimate entries. Now, if they trigger, theoretically, all of these could trigger on the same day, but it doesn't mean that if all 11 of these trigger on Monday, that I'm going to buy all 11. No, I am going to, even if there's 11 legitimate trades, I need to narrow down those 11 to the best one. And so how do I do that? Well, I give them a quality score. Just to make it simple, if one has one entry signal and another stock has two entry signals, very likely I'm going to take the one that has two, right? So I have to look at how many entry signals give that a score. Then I also have to look at the risk to reward, and I have to counterbalance that. Maybe I have something that has four signals but has a really bad risk to reward. Well, I have to take some points away from that, and I may not even take the trade. I also look at the weekly charts. I look at the longer term charts to see maybe if I have some information there. Maybe I have a legitimate setup both on the daily and the weekly. That helps me maybe make the decisions. And then I also like to look at the relative strength. Maybe the market's down, but this particular stock is up. Gets a few added entry points there as well. And so this is how I trade. This is how I teach my students. And by the way, I teach students all over the world. I offer a really great course. It's a 20-hour course. It's one-on-one. I think the best way to learn anything is one-on-one with your instructor. And we do 2 hours per week, and we do it for 10 weeks. So you get your 20 weeks. But in that course, I teach you step by step everything that you need to know to be able to trade like I do. We go through every rule, every little minute detail of every trade. I teach you, we go over them. over and over. We do a lot of simulation trading, and it's a great course. I've turned out some really great traders, like I said, all over the world, from absolute beginners all the way up to the hedge fund level. So if you would like to improve your trading, if you'd like to work with a coach that really cares about his students and really wants them to succeed, send me an email. The email is in the link in the description. I will do my very best and teach you everything that I know, and hopefully teach you a trade, or teach you a skill that you can use the rest of your life. It does cost $2,000, but it's an investment in a skill that you can use, like I said, for the rest of your life. So it would be great to hear from you. Send me an email. We can get the conversation started. So that's the live one-on-one course. If you like video courses, I have a really good video course available at udemy.com where I teach you step-by-step how to trade the deep dip buy stock trading strategy. I've sold so many of those courses around the world, has such good feedback. And if you're interested in that course, it's very affordable. It's between $30 and $50. The link to that course, the Udemy link, is in the description of this YouTube video as well. So if there's anything I can help you with your trading, whether it's teaching, consulting, anything, please reach out to me. I think there's a lot of different ways I could help to improve your trading. And so I look forward to hearing from you. So, okay, thanks for letting me put my plug in there, and let's get back on with the potential trades for next week. Okay, here's AMD. Clearly, AMD was down this week, much stronger than a lot of stocks, though, because we are still over our 200 days. So the green block is an order block, clearly, and look, we have a 200-day moving average that now lives inside the order block, making this a pretty easy potential setup to look for. So next week, I am looking for two things. The first would be a rejection of the 200-day moving average, either a close under, close over, bounce, or intraday rejection of the 200-day moving average. And if that's the case, then that 200-day moving average will become my line in the sand, my end of our stop. Alternatively, a rejection of the bottom of the order block is also always legitimate, and it looks like the bottom of that order block is 194.16. So first of all, I'm looking for a rejection of the 200-day moving average, 195.16 as of today, or a rejection of the bottom of the order block, 194.16. And this is kind of what I was talking about with relative strength. AMD down clearly, but much stronger than the rest of the market. So I put that away in my head. And so if AMD triggers compared to NVIDIA triggers, I'd probably go with the AMD because the relative strength is higher. Okay, Amazon. Well, Amazon's really had a bad day on Friday. What I am looking for, we are in this order block. Okay, we're in an order block. And let's quickly, why the order block? We have a swing low, we have a swing high, we have a lower swing low, we change market structure here, defines the order block, lowest closing bar before the order block change. Okay, I take the high and the low of this bar, move it into the future. Now, we don't have any moving averages inside this order block, but here on the 17th, we had a big up bar. Remember what I said about big up bars? If you have a big up bar, halfway of that big up bar very often provides some type of support. So I put my own custom level 198.70 into the order block. Well, you can see Amazon down dramatically on Friday, but we are getting very close to potential rejection of this 198.70. So Monday, if it went down, closed back above, could be a potential trade, right? And then I would use my 198.70 as my line in the sand, my end of bar stop. And of course, there's the bottom of the order block. The bottom of the order block with a rejection of 197.27 would also be valid. The Dow, DIA. Oh, man. I'll tell you, everybody, we are getting into some pretty serious levels here. You can see 300-day moving average, the order line inside a previous order block from the past was not strong enough to close above it. We are also at a 28.99 RSI. Now look, if we have a rally back up on Monday, there would be a lot of entry signals that would happen. One, we'd have a close back above the 300-day moving average, which by itself completely standalone legitimate entry signal. If it does close above the 300, it will also close above the 30 RSI. And one of the strongest confluence of signals is a close below a major moving average, close above a major moving average. At the same time, you have a close below the 30 RSI with a close above the 30 RSI. One of the best high probability setups, rejection of a major moving average, rejection of the 30 RSI on the same day. Well, if for some reason we rallied on Monday, I don't know if we're going to, but if we did, that would be a major signal. But in addition to that, we are also inside of the order block. So it's key level within key level, in this case within key levels. So if we get a close above that 300-day moving average on Monday, I would certainly consider that trade because of all the confluences. GDX, which is the gold miners ETF, this one's pretty simple. We have an order block way from the past. Of course, GDX had this huge run, and now we've had this huge pullback. But we are coming to a very interesting location. And right now, what I'm looking at, I'm looking for a rejection of the 200-day moving average that lives inside this order block. The 200 at today is 77.13. So if next week we do move down, reject that 200-day moving average, and has good risk to reward, I would consider taking that trade. And then my end of bar stop would simply be a close below the 200-day moving average. Goldman Sachs, well, we're getting to very key level here as well. We have an order block in the green. We have a 200-day moving average living inside the order block. It's very close to the high of the order block. What I'm looking for on GS would next week would simply be some kind of rejection of the 200. The 200 is at 797.33. If it rejects that 200-day moving average, it would also reject the high of the order block, two major signals. And so I would consider taking the trade there. My stop would be a close back below the 200. That would be my end of our stop. McDonald's. Really what I'm looking for in McDonald's, there's the 200-day moving average that it rejected at the top of the order block. That was a legit trade. I didn't take that trade. Right now, we're still above the 200-day moving average. But really what I'm looking for on McDonald's is a rejection of this 300-day moving average. The 300-day moving average at the moment is 303.41. We're at 305.90. So if we're down on Monday, very likely we could reject this 200. That would be, listen, whenever you get major large cap stocks that are at their 300-day moving average, clearly something's going on. But historically, when you get near the 300-day moving average on any large cap stock, it's generally a good place to buy, but not just buy blindly if you have the rejection. So right now, currently what I'm looking for on McDonald's, I'm looking for a rejection of the 300-day moving average sometime next week of 303.41. Morgan Stanley, MS. Well, here we have the order block. Here we have the 200-day moving average. You can see Morgan Stanley closed below the 200-day moving average, closed back in the order block. Going forward next week, if we are able to close above the 200-day moving average, so in this case, it would have to close up. But if it closed above the 200-day moving average, it would also reject the high of the order block. Now, conversely, if it continues down, with a rejection at the bottom of the order block, 154.38, that would also be a potential entry as well. And then use that one for, I would use the 154.38 level as my stop. But really, I feel better about it if Morgan Stanley MS were to close above the 200-day moving average and the order block. And if that were the case, I would my end of the bar stop would be a close below the 200-day moving average, whatever it is. Right now, it's at 159.26. Microsoft, my gosh, it's horrible. Look at this. We're at a 22.29 RSI. We have an order block away from the past. We are back to the levels that we were a year ago on Microsoft, if you can believe it. So what I'm looking for on Microsoft is a rejection of the bottom of the order block at 346.61. That's about 10 points below where we are, but it's certainly possible that it could get there. So that would be, with this move back down, I would expect that at some point we would have a bounce on Microsoft. And a rejection of that bottom of the order block is about the only thing that I can see right now. So the rejection is 346.60, or the bottom of the order block is 346.61. So I'll be watching that level for rejection. NVIDIA, this actually triggered on Friday. It did reject the 250-day moving average inside the order block. I took the Qs instead. But if we open up down, but sometime during the week we close back above the 250-day moving average, potentially could get in there as well. And the 250-day moving average at the moment is 167.30. You can see we're at 167.46, so it did reject it. But going forward next week, I'd look for another rejection of the 250 or potentially a rejection of the bottom of the order block, 163.83. The S&P 500, we lost the order block, but we did reject the 300-day moving average. Technically, that was a legitimate signal on Friday. Same with the Qs. That's why I took the Qs. But as with the Qs, we're at a 28.08. If we could close back above close back in the order block, we would also by default close back above the 30 RSI. Totally legitimate signal. So if next week we do close back in the order block, like I said, by default also close back in the 30 RSI, it's a good high probability trade with a good risk to reward ratio. Doesn't mean it's going to work with all the volatility that's going on in the work, but we are pretty low. We are at some key levels, but I would like to see the SPY, just for the sake of this podcast, if the SPY were to close back above the 30 RSI, that would be a legitimate signal because it's closed back above 30 RSI, deep dip buy, and would also close back in the order block. And then last but not least, XLV. XLV's had a tough move just like everything else, but we are into a previous long-term order block. We were not strong enough to close above the major moving averages, but next week, if we were to close above the purple line, which is the 250, that would be legit. If we were to close back above the 300-day moving average, it would be legit. If it rejected the bottom of the order block at 142.75, that would also be legit. So that's what I have for next week. Listen, it's brutal out there, right? Everything that's going on in the Middle East and, on Wall Street in general, there's a lot of fear out there. But like I've been showing you here on these setups, we are at some key levels. It doesn't mean they're going to hold. But if they do reject and hold, yes, I will take them, right? Regardless of what's on the news. And if they close back below, I'll just get out. So please be careful, everybody out there. Mark your levels, follow your process. You can have the best process in the world, but if you don't follow it, doesn't do you any good. But the bad news is, yes, the market really is moving down strong. The good news is we are getting to some key levels. So let's just see if these key levels can hold, and maybe we'll put in a short-term bottom, or maybe we go down lower. You just don't know. We have to be open to both possibilities. So listen, I always like to leave off with, please try to go out and try to do one nice thing for another human being each day if you have the opportunity. Really, it would make the world a lot better place, and we certainly could use a little bit of that at the moment. I'm also a big animal lover. If you have the opportunity, whatever day, if you can have and make an act of kindness for some kind of animal, if they were in need, or they come across your path and you could help them, just do it. They appreciate acts of kindness just like we do. And we just need a lot more of that in this world. So I have this tiny little platform, but I at least like to leave off with that. So listen, if I can help you with your trading, let me know. I'd love to have you as a student for my 20-hour one-on-one course. Teach you everything that I know. If I can help you with any type of consulting or anything other trading related, love to do that as well. Just send me an email. The email is in the link of this YouTube video. So thanks, everybody. Hope you enjoy your weekend. We'll see what happens next week. And God willing, I'll see you next weekend. And we'll see what happens with this week, right? Thanks, everyone. Appreciate it. Have a good rest of your weekend. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.